All right, let's jump right in with something that sounds, well, completely backward. What if I told you that for a startup, making a profit could actually be a bad thing? Yeah, I know, it sounds nuts, but in the high-stakes world of venture capital, this is a paradox you absolutely have to get your head around. So, let me ask you a question. Real simple. What's the number one sign of a healthy business? I mean, for most people, the answer just pops right into your head, doesn't it? And of course, conventional wisdom, what they teach you in business school, what every textbook says, it's profitability. Simple. Making more money than you spent. That's Business 101, the basic goal. But here's the twist. For those high-growth startups we all hear about, the ones that are trying to change the world, that answer is often dead wrong. In fact, being profitable can actually send up a huge red flag to the very investors they're trying to win over. And that right there is what we're calling the profitability paradox. Let's dig into why VCs, the people with the money, will almost always choose explosive growth over nice, steady profits. And look, this isn't just some gut feeling or a Silicon Valley trend. It's in the data. When you look at SaaS companies, that's software as a service, there's this one magic number that tells the whole story. 2.5. That's right. Research shows that a company's growth rate is literally 2.5 times more important than its profitability when investors are trying to figure out what it's worth. This chart really spells it out. Look at the correlation between just growth and valuation. It's pretty strong, right? A 0.39. Now, what happens when you add profitability to the equation? You'd think it would jump, but nope. It barely nudges up to 0.42. That tiny little bump tells you everything you need to know. It shows just how little VCs care about your profit today compared to how fast you're growing. Okay, so why this obsession with growth? Well, it all comes from this really influential mindset that has basically defined Silicon Valley for years. It's called the blitzscaling bias. So what is blitzscaling? Think of it like a land grab. It's a strategy where speed is the only thing that matters. You grow at an insane, breakneck pace, not to be efficient, but to capture the entire market and become the dominant winner-take-all player. Everything else, especially profits, can wait. It's about getting big fast. And here's a quote that just says it all. It basically admits that startup valuations have become decoupled from their real underlying business value. It's all speculation. It's a huge bet that if you pour enough money into a company, even at a loss, you can grow so fast that you'll achieve total market dominance. It's a gamble on future power, not present performance. So this whole growth-first mentality, it completely flips the script. Suddenly, something that seems like a good thing, being profitable, starts to look like a weakness. To a VC who's hunting for the next unicorn, seeing that you're already in the black can actually raise some serious red flags. 4 of them, in fact. Okay, so what are these red flags? First, if you're profitable too early, the investor might think, maybe your market is just too small. Like if it's that easy to make a profit, maybe the total prize isn't big enough for those huge 100x returns thereafter. Second, it could signal that you, the founder, are too conservative. You're not thinking big enough, not swinging for the fences. Third, it suggests you're vulnerable. While you're carefully counting your pennies, your competitors are spending big to grab market share, leaving you in the dust. And finally, and this one's a bit cynical, profitable companies just don't need as much cash. And VCs, they need to write big checks. That's their business model. I mean, just think about the classic example, Amazon. For years and years, Jeff Bezos famously ran the company with razor-thin profits, or even at a loss. Why? Was it a bad business? No. It's because every single penny was being plowed right back into growth. More warehouses, new product lines, faster shipping. That lack of profit wasn't a mistake. It was a core part of the strategy. It was a feature, not a bug. So, as a founder, you're caught in the middle of this. It forces you to make a really tough strategic choice. It's a classic trade-off, really, between your company's valuation and how much control you get to keep. You've basically got 2 main paths you can go down. Path 1, you optimize for a massive valuation. You chase that hypergrowth, you raise enormous rounds of funding, and you accept that you're going to give up a big chunk of your company. It's high risk, high reward. Then there's path 2, you optimize for control. You build a sustainable, profitable company. Sure, your valuation might not be as astronomical, but you own more of it, and you're not at the beck and call of your investors. But wait, what if there's a third way, a kind of have your cake and eat it too strategy? It's a staged approach. Here's how it works. Step 1, you actually do become profitable, but on a smaller scale. You prove your unit economics are solid, that you have a recipe for making money. Step 2, you take that proof to investors. You can walk in and say, look, the machine works. We know how to make a profit. Now we just need your capital to build a much, much bigger machine. Then, step 3, once you have that capital, you hit the gas. You intentionally shift back to prioritizing growth over profit, but you're doing it from a position of strength and on your own terms.
Okay, but it's really important to get this next part. This growth at all costs mindset isn't forever. The profitability paradox isn't a permanent state of being. As a company gets bigger and older, the rules of the game change completely. And profit, well, it starts to matter again. A lot.
You can see this play out over a company's timeline. In the super early days, pre-Series A, it's all about growth. Growth is king, queen, and the whole court. But then you hit Series B, and the conversation starts to shift. Investors want to see a light at the end of the tunnel. They'll ask, okay, what's your path to profitability? And then, by the time you're at Series D or thinking about an IPO, forget about it. Profitability is no longer optional. It's essential. The public markets, they have way less patience for burning cash.
So, in the end, it all boils down to this one big strategic question for any founder. Now that you understand the paradox, you have to decide. What are you building for? Are you playing the valuation game, chasing massive growth? Or are you building for control and sustainability? There's no single right answer, but the one you choose will define everything that comes next.